Pretty good article I came across here the last couple of days when I was doing some research on mortgage debt and retirement planning for a video I was doing on reverse mortgages. And I'm going to read it to you here. It's called Retiring with a Mortgage from MoneyZine.com. Actually, a pretty good article. I take some serious umbrage with some of their conclusions, but it's a good article nonetheless. And it might open some eyes, frankly, when it comes to your own retirement planning. And I hope if you're attuned to this channel, you can see where I'm going with this, because I'm telling you, man, my number one thing when I'm doing retirement planning, if you got no mortgage, you're in good shape. Literally, that's it. That's literally that simple. If you have no mortgage, you're going to be at a good place. If you have a mortgage, it's tough. That doesn't mean if you do have a mortgage, you should jump off the Empire State Building. But man, if you do what you got to do to get out from underneath that, because when I share with you this article, it might help you, persuade you to go that route. So let's dive right into this, my friends. Welcome to the Heritage Wealth Planning YouTube channel. Don't forget to subscribe down below. This is the place you come to learn about financial planning, good, bad, and lots of ugly. So subscribe, comment, thumbs up, give me a share the video if you will, and let's dive right into this. So if I can get my minute, there we go. All right. So this is dated 1st of November 2018, so not that long ago. Who is the author? I didn't catch the author. So I'm not sure who it is. MoneyZine.com. And I'm not familiar with these guys, but it actually came up in my Google search real quick. So these guys obviously just have some what's called page authority and page authority, another one, but because this came up in Google search. So good on them for having a good blog. I'm not familiar with them, but I think I will be as the time goes on, because I do like this article. All right. There was a time when retiring with a mortgage was unthinkable. Making that last payment was something to celebrate, and the achievement was shared with friends. There is even a name for those celebrations. They were called mortgage burning parties. In this article, we're going to discuss pros and cons of retiring with a mortgage. There is no pro. We'll begin by citing some government-sponsored research that provides several interesting statistics on the number of retirement-age individuals who are still paying off the loans on their homes. And next, we'll talk about various factors to consider when deciding if paying off a mortgage is a good idea. And finally, we'll expand that into a retirement planning scenario. So every year, the Federal Reserve Board publishes a Survey of Consumer Finances, the SCF. This is based on responses of 4,500 families that are representative of the economic conditions existing in the U.S. The survey includes demographic characteristics as well as pension and income information. The data we're using in this article was published in September 2017 and is a summary of the data gathered from the years 1989 to 2016. So a pretty big constituency here in terms of the survey. Let's put that with the Survey of Consumer Finances. Lots of good surveys out there, without question, real world surveys. Don't just use projections. Use real world data. I'm telling you, man, all these people, you should, no. Show me the stats, like that Tom Cruise guy. Show me the money. I don't even know who that guy was. Tom Cruise, and who was the other guy? I forgot. I can't remember what that movie was called. I don't even think I ever watched it. Just remember the Phoenix Cardinals. Show me the stats before you tell me why I should use your projections there, Mr. Financial Planner. All right, the data we talk about, the table below tells us the percentage of families that still have a mortgage or home equity loan. He used loans. I wonder if that's synonymous with lines. My presumption probably is. Loans and lines, just a second mortgage, essentially. Sorted by the age of the head of household. So here in 1989, if we'll just say 65 to 74, 20.6% of the people 65 through 74 head of households had a mortgage or equity loan. Now it's 35.2, which is down from 38.9 just 3 years ago, 2013, or I should say 5 years ago. The percentage of people, that's a 50. When I do my trusted calculator, right here. So that's still a pretty significant. I mean, you're talking 15 divided by 20. That's a 75% increase, my friends, the number of people who have a mortgage when they're 65 to 74. And that's nuts. 75 years old. You had 5.8. We'll just round it up to 6. You got 23.2 minus 6. 70, that's, man, divided by 5. That's a 300% increase, 296% increase of people aged 75 or older who have a mortgage. So right now in 2016, 23.2% of the households of the 4,500 they surveyed had a mortgage. Now, that's interesting. I wonder if this is carrying over. So we got less people 65 to 74 and more people 75. So I'm wondering if some of these people in 65 to 74 cohorts in 2013 are now these same people in 2016. Either way, that huge increases the number of people who have mortgages. And yet look at 2016 to 1989 for ages 45 to 54. Less people have a mortgage in 2016 than they did in 1989. But then, yeah, look at that, less across the board. I wonder what you could attribute that to. That's interesting. Maybe tighter underwriting? I don't know. And 35 to 44, yeah, less than half of people in 2016 had a mortgage who are the age of 35 to 44. That's got to be pretty good. That's interesting. I don't know what to attribute that to. I will see if they say anything about that. All right. To simplify this analysis, we'll consider families where the head of household was age 65 or older as retired with a mortgage. The observations we can make based on this research includes, we already talked about back in just over a quarter, back in 2006. Okay, we were talking about, we are a 200% increase in mortgages for family where the head of households was 75% or above. Actually, it's 300% to be 75 years older or above is actually 300%. And second set of data, we're going to look at how much debt these retirees are carrying. That's even more important. Are they adjusting it for, doesn't look like it's being adjusted for inflation. All right, so 1989, they're carrying $33,000. If you're 75 or older in 1989, you're carrying $33,900 of mortgage or equity loan debt. And 2016 is basically twice that, 3 times that. I don't know what you can... I don't know. That's just different. I mean, the cost of housing, inflation, whatnot. You can't just look at that without looking at the other factors there. But either way, I could care about less about 1989. I do care about if in 2016, the average head of household who is 65 to 74 had a mortgage debt of $118,000. The average head of household who is over 75 had a mortgage debt of $92,000. That's nuts. Again, we're using a simplifying assumption that the head of household age 65 and older is retired with a mortgage. Based on the second set of data, we conclude the average mortgage or home equity loan for retired families where the head of household was age 75 or older increased in size $136,000. Yeah, but see, I don't like that because the homes have increased in value. Even more incredible. I don't like that. The 2016 data sustains a continuous climb in mortgage and home equity loans. You can't. That's not a good comparison. What you should just do is how many people have debt at 65 to 74 on their mortgage, and what is it? And so right now, 35% of all people out there have a debt on their mortgage who are 65 to 74, and of those people, the average debt is $118,000. All right. We now have a lot more. Okay, based on these two sets of data, we now know the number of retirees of mortgages have been increasing significantly. Yep. Overall, we now have a lot more debt held by those in retirement than we did back in the 1980s. That's true. Paying off with a mortgage. Note, we're going to start this section with a warning. A mortgage is typically the largest loan carried by a household. Paying off a mortgage is a very big decision that needs to be thoroughly evaluated before taking action, blah, blah, blah. I don't know. Again, my experience, many years in this business, no mortgage is a better place to be. I don't know what that's like other than having rented a couple times. But if I'm retired, that's where I want to be. Anyone looking to pay off a mortgage must have excess funds that can be invested in their loan. No. You don't have to have excess funds. You can have a reverse mortgage. Hey, this is what drives you crazy. Look, I don't know who these guys are, but you don't need excess funds to invest in your loan. You don't. Once that condition exists, the loss opportunity cost is a primary factor determining whether paying down or paying off a mortgage is a sound decision. The opportunity cost would be the alternative investment. For example, someone could choose to invest in the stock market instead of paying off the loan. Paying off a loan is a low-risk investment. Money applied directly towards the loan principal provides the individual with a return on investment that is equal to the interest rate of the loan. That is true, 100%. Since this is true, we can make two generalizations. When the interest rate on the mortgage is higher than the alternative, i.e. risk-free investment such as a certificate of deposit, it's better to pay down the mortgage than invest in the CD. I agree. When the interest rate on a mortgage is lower than the alternative risk-free investment such as a CD, then it's better to invest in the CD than pay down the mortgage. So essentially, if you're paying 3% on your mortgage and you get 5% on the CD, you'd be crazy, according to this, to pay off the mortgage when you're getting a higher rate of return on the CD. That's a risk-free investment, though, and there's no CDs right now that are paying anywhere near your mortgage payment, that's for sure. And don't even say, well, I can deduct the interest payment. No, the vast majority of us are not going to be able to do that anymore. Alternatives to consider. One of the simple rules of thumb used by many planners is that we need to have enough resources to replace 70 to 80% of our income when retired. The rationale is that when retired, our expenses should be lower. For example, retirees no longer have a commuting expense to travel back and forth to work each day. This rule was also developed at a time when very few retirees had a mortgage to worry about each month. Okay. Based on the rules mentioned above, it might be tempting to use a 401k or Roth IRA to pay off a mortgage if prevailing rates of return for those plans are lower than the interest on the mortgage. Unfortunately, those decisions are not that simple. Living a comfortable retirement means balancing the desire to pay off the mortgage with the need to have a readily available source of savings to help pay for unexpected expenses. The last thing one will want to do is pay off a mortgage and be forced to take out a home equity loan to pay for medical expenses. This is like Dave Ramsey stuff here. Oh my goodness, you're not going to take out a home equity loan if you have no income, my friends. It's just not happening. So you pay off your mortgage. You have $200,000 in your 401k. You use it to pay off your mortgage. You have no mortgage now. You're living large. Now you get some unnecessary medical expenses. And you say, how do I pay for this? I'm going to go to the bank to get a home equity loan. It's not going to happen. They're not going to loan you money. You have the income to support it. Remember, how do you pay for the loan? You have your cash income. Your income is what is going to support the loan. If you don't have enough income to support the loan, the bank sees they're going to have to foreclose on you. And banks don't want to do that. If someone is carrying high-cost loans such as credit card debt, then it makes sense for them to pay off a credit card by turning their attention to a mortgage. Okay, so using a mortgage to pay off their credit card. Well, before turning their attention to more. Okay, gotcha. So if you got 3.5% on your mortgage and 8% on your credit card, don't even worry about your mortgage. Worry about your credit card. And I completely agree with that. Similarly, if an investment can earn a higher rate than the interest charged on the mortgage, then making the investment is a better choice. Just keep in mind that higher returns are often accompanied by higher risk. That means you might not get that higher return. Again, projections versus guarantees. We guarantee you your mortgage is going to cost you a certain amount of money. We cannot guarantee your investments are going to earn you a certain amount of money. In the end, anyone trying to figure out retiring with a mortgage is a good idea will need to consider the alternatives. Are there risk-free investments to provide a higher rate of return than the interest rate on the mortgage or home equity? And the answer is no. Liquidity. I mean, a 10-year treasury bond right now, about the most risk-free investment you can find that's competitive to a mortgage rate is paying 2.7. That's just so there is no. And then again, those are going to be taxable too as income. Liquidity. The last thing anyone wants to do is use all their readily accessible money to pay down a mortgage and then borrow money for rainy day expense. All right. So the ideal situations where someone has a relatively large sum of money in the bank or in a modest mortgage, paying down that makes a lot of sense, especially if currently invested in a CD earning around 1.5%. Okay. I'm stunned that they don't talk about reverse mortgages here. Stunned. My wife just texted me. Sorry, guys. I don't get why the financial community is so hesitant to look at reverse mortgages. If you got a $200,000 home, and I don't know the numbers, you have to look at Wade Fowle's site at retirementresearcher.com, and you owe $100,000 on your mortgage. Why not take some of the equity that you have, do a reverse mortgage and pay that sucker off and leave your investments there? It's the best of both worlds. Now you're essentially saying I have no debt other than my reverse mortgage. Yeah, it is a debt for sure, but now I have my market, so I don't have the opportunity cost. So now I don't have the cash flow going out, and I have the opportunity cost of allowing the market to continue to work its magic if it were to do that. I don't understand why that's such an issue. Yeah, a reverse mortgage is going to cost you probably $10,000. I get that. And it will be used against you when you die and you want to leave your home to heirs. I get that too. But all I care about is you right now. And your heirs are still going to inherit what you left them in your Roth or your 401k or 403b or TSB. It's more than just binary decision here. I don't get why the financial planning industry as a whole can't get this right. It's just it's a huge mistake to me. Huge. So you're using your equity to pay down pay off your home, and you have no payment due, freeing up that equity, that cash that you had over here, that way you don't have to tap into it to pay off the mortgage. And on top of that, freeing up the cash flow that was going out on the income statement because you no longer have a debt. Anyway, so a decent article. I took huge umbrage with it and not being able to see the benefit of a reverse mortgage. All right. Well, as always, hope you find this helpful. If you like what you see, subscribe, comments, thumbs up, the whole thing. Share on Facebook. Share on any of the other YouTube. Share with your friends and neighbors as well. And we'll see you guys next time. Thanks now.